Welcome to the June 15th, 2020 Advance Report for McGowan Group clients and NetWorthRadio.com listeners. I'm Spencer McGowan, your financial weatherman and president, McGowanGroup Asset Management at the Crescent in Dallas. We're going to start this week with your fast-paced tour of the global financial markets. We're going to go Dow 3-year. Usually we've been doing year-to-date. Why did we do 3 years? Well, the Dow this week had a decline on Thursday of 7%. They blamed it on fears of a COVID resurgence. That was not really any part of the financial data, and there were no credible stories. It was just a mantra. What was the real reason? It was a similar decline to the last time Federal Reserve Chairman Jerome Powell spoke. Anyway, after the Friday rally, I wanted to see where are we on the Dow on a longer-term basis. December of 2017, 3-year chart, that's the first time the Dow was at this same level, essentially 25,300. Wow, that is a long range-bound market, and that's essentially zero return or just the 2% dividend yield for the last 2.5 years. That is not uncommon for equity index investing, and I believe we have a better strategy, especially as we go into July, which is going to be corporate bad news for the second quarter shutdown. Well, what's ahead? This is the Dow 15 years. The low in the Dow was 6,500 back in 2008. You can see 2009, there was a recovery, and then you were more or less range bound until 2012 when earnings really started to pick up. This is the first time the Dow hit a new high. What actually recovered to record profits faster? Well, we're going to get to the high yield index here in just a second, because that strategy, getting paid to wait and owning great assets at discounts to a realizable value, was part of that strategy that helped us to recover. Now we look at this, you can see the Dow essentially range bound in this period and not dissimilar in the decline. That was about 50%. This one was about 38%. And we're likely to have to fill in, like we did this week. Basically, you're in irons for an equity index. There are much better solutions out there, and we're about to hit the high points. Job openings. There were 7.5 million jobs available and only 6 million people looking at the time we finished 2018. Right now, there's still over 5 million jobs posted to be filled. That's good news. 2.5 million jobs restored in the month of May. At that pace, it takes about a year to reach record employment. And this is actually, it looks like a cliff, but we went from 7.5 million at the high down to about 5 million jobs posting. We're going to watch this number more closely in the future episodes, so be sure YouTube McGowan Group subscribe. Here we go. GDP, updated figures. I've got a key number in here. Damage to the second quarter economy, an annualized contraction rate of 35%. That corresponds to a near complete shutdown in the month of April. Third quarter, yes, a 19.9% increase in GDP projected. That is important because we cited that report during the pandemic, and the lowest point, we said, hey, we've got economic reports, there could be a 19% recovery. It looks like it's going to be 20%. And then, each quarter thereafter, still adding back. How long does it take the economy to get to record levels? That corresponds to what I said about the Dow maybe not reaching a new high until 2023, because here we go minus 5.7% is the entire year impact projected, and we go 2021, 4%, 2022, 2.9. If you do the math on that, the economy reaches a record somewhere around the end of 2022. Seems like a long time, but it should go relatively quickly. If your portfolio pays you real interest and dividends every month, then you get paid to wait. This is the NASDAQ. I want to point something out. This is just 15 years. But before this started, the NASDAQ had a decline of 80% in the tech wreck of 2002. 2003, we used high yield bonds to recover, but this is the tech index. And technology, the most favored part of the market right now. What I was pointing out here, if you look at these declines, there's 2008, there was 2001. Those declines can be very large and very fast. It's very hard to stay in a category when it loses 30 or 40% like it did here. But the technology companies are where all the money flow is going right now, which corresponds to our growth units discipline for those of you that actually can withstand volatility. And of course, there's no yield. Now, we did buy some medical dividend companies during this period right here, and this is the healthcare sector over a 15-year period. Also a very successful run because it's a type of technology. And medical revenues likely permanently higher in what we call perpetual pandemic preparation. High yield bond index, 15 years. I'm coming back to this because it's important. We are par value about 100, the low in the panic of 2008, 61% of par value. So that implied that 39% of the companies in the B space were going to default. Didn't happen. You can see the rapid recovery there to an equilibrium about 95. Currently you're 82. We went all the way to 68. Well, you got paid during that period. You could reinvest. Now we're back at 83 cents on the dollar. Those are the B-rated companies. Distressed is C and below, and the B-rated is the normal lending market. Investment grade, of course, is the A space. This is still interesting, and it still has gain potential. If you go from 83 to say 96 or 97, that's a nice 15 to 20% gain potential, plus the yield while you wait, and there are even larger discounts available in the global high yield space. Here's the strategy and the way it worked through 2007 through 2012. Now, the volatility to the downside, the potential loss if you sold right there, was not dissimilar to equity. The index, as I mentioned, went down to about a 61% of par. But if you reinvested that whole time, by the time the Dow actually recovered, key point, global high yield had a compounded total return of 14% average annual, and domestic high yield, our example here, did about 10%. And so that was a way to have a consistent return with somewhat less volatility and more reliability because it's a basket of bonds and loans. So that's one of the key strategies that we've been featuring. West Texas Intermediate crude hit minus 37 a barrel this week, went almost to 40, finishing the week in 36 and change. There are projections that we covered last week from an institutional research source that the Saudis and the Russians want $55 a barrel. They need that to make their budget, and they'll adjust production to get there next year. And so that's one of the key points. This could be 55 next year according to some of our sources. But if I own the infrastructure and I get paid for the flow through the pipelines as that restores, that infrastructure could be one of the keys. The futures market is already showing by the end of 22, $41. And those futures, if we were pricing at 55, which was the projection, no guarantees there, but if that happens next year, then you're probably looking out here at something that could be closer to 60. And of course, that would bode well for money flows into the energy infrastructure and other categories. So, come down to the Crescent, get your plan updated. We look forward to seeing you. We are fully operational with safe operations, hand sanitizers, face masks, and they're free, and they have our logo on them. We are resuming the client planning appointments and the reviews for the post-pandemic success of our clients. I'm Spencer McGowan. Thank you for joining us at YouTube McGowan Group. Thank you for tuning in to our YouTube channel. I'm Spencer McGowan, President, McGowan Group, your financial weatherman. We sponsor each week NetWorthRadio.com broadcast that has the charts and graphs, many of which you saw today. We also sponsor this YouTube channel. Be sure to subscribe for fast breaking news, an alert when we post something in a market condition that may have changed. Our goal is to help you as an investor make the right decisions at the right time. And that's part of what this YouTube channel is about, as well as NetWorthRadio.com. I am well served with a team of 10 people, including myself. And that team that cares is actually made up of people who devoted to your net profits and your success, as well as excellence in service. If you want an educational experience to follow this up, get to NetWorthRadio.com, the McGowanGroup.com. Right here, we disclose our net client experience all the way back to 2001. What that includes, the bear market cycles of 02, 08, 2018, and the recoveries through the most recent quarter. That is true education of investors and exactly how our clients have done, disclosed right here. Further disclosures, value at risk of loss. Yes, investments are going to fluctuate. That's part of the reason for this broadcast. And that can actually work to your advantage. We'll build that into your plan. So I urge you to go to NetWorthRadio.com, fill out the preliminary client questionnaire, a free 1-hour brainstorming session by phone or at the Crescent in Dallas, and we will map out a multi-year plan for you and your family that's appropriate. Just because we talk about a security on this broadcast or any securities doesn't make it a recommendation for your portfolio until you have that written plan. Thank you for tuning in today, and we'll be back next week as your financial weatherman.